please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Good morning. Welcome to Morning Call. I'm Lata and with me Anuj and Sonia. Another day, another fall. Now it is 10%. Now it is correction. No longer a pullback. It's a correction. And it is not small change. It is $5.2 trillion that has been wiped out in market cap across the world. So now even people who would have taken the previous fall in their stride would have to worry a little and wonder whether this dip has to be bought or you have to wait for a little more before you get things cheaper. Once that psychology settles in, then you have a problem of a self-fulfilling spiral. The reasons are not far to speak. Once again, it is the bond bear that is growling, and you're seeing the yields go again to 4-year highs. And like in India, the reasons are the same. Good growth, the fact that central banks are going to roll back their balance sheets. And 3, which we are not talking enough, US fiscal deficit also is going to be higher, just like Indian fiscal deficit. President Trump promised a fiscal stimulus. So the bond bears in the US have much to worry about and many arguments on their favor. So now our bonds and our equities will follow suit. Both will fall together. The point is now, where does the spiral stop? We don't have answers, we only have questions. At least I have only questions. Morning, both of you.
Hi, morning, Anuj. Morning, Lata. I know, will it be a freaky Friday? Nobody knows. But you spoke about good macro data. There's great macro data in the US. If you saw the weekly jobless claims, they fell to a 45-year low. I mean, that's something we haven't seen in a very long time. And I was just going through some of the data from FactSet. You spoke about, a bear market territory or a correction. More than 10% of the S&P 500 stocks are now in a bear market. So 60 companies are now below their 20% below their 52-week highs. So, there's a lot of damage that we're seeing over there. And you just heard a commentator say that the market slipped below the Tuesday low. So the question we're asking is our Tuesday low sacrosanct, or is there a possibility of slipping below that as well? Anuj, morning. What's the sense you're getting? You have been saying that we could go through a lot of volatility, and that's what's happened. One good day, one really bad day. But is that Tuesday low sacrosanct, or could that be given up?
I don't know if that gives up or not. The short point here is, and we discussed this in closing bell yesterday, Sonia, you don't know what's happening in the US market overnight, and you don't want, yesterday I got a WhatsApp forward. This is on a lighter note, since we're Friday, like, a bit of a शायरी, like, एहसास मोहब्बत क्या है, जरा हमसे पूछो, करवट तुम बदलते हो, नींद हमारी खुल जाती है. It's like, Indian market telling US market. And at 10 o'clock, 10:30, you're seeing US market and you don't know what's happening. Absolutely. At, 3 o'clock, where it will be. So if you bought yesterday, say at any point, this morning, what do you do when you're sitting on a 200-point sort of mark to market? So, either you are brave enough and you want to preempt the US market move. For example, do you want to preempt the US market move for tonight and want to go home with, say, long positions after this gap down? Do you want to do that? That's, anyone's call.
It requires a very brave man
to do that. So I think you approach this market from 2 ways. Either you just say that I ignore all the noise, I just make a shopping list, good quality stock, and good quality stocks, by the way, earnings have also been good. So, you buy them regardless of what the market does, or you go with the flow and, every day you take a call on the market and you take trading positions accordingly. For today, we'll of course have a gap down below yesterday's low. So let's see, Tuesday's low of 10,276 is now sacrosanct. My sense is that, you're opening at 10,350 as per the SGX Nifty. So the risk is there, but do we go there? I don't know. Over a next 2 or 3 week period, there's a good chance that this market finally decides to test its 200-day moving average. We haven't done that yet. Which is 10,040 right now and is rising. So by the time we go there, it might be 10,100. And one more point. Anecdotally, the bull market's correction ends with a double test of a bottom. Whatever bottom you make, in this case, maybe Tuesday low, whatever, you want to go there once again to see if that was a durable bottom or not. But many good quality stocks have managed to survive correction. And yesterday we saw earnings were good. Look at the Page Industries numbers, ACC's numbers, Heidelberg's numbers. So obviously, it's not just, because US markets are down, you want to sell. The big question now is, when will the decoupling start? You'll remember that phase when we went through in the 2000s, early 2000s.
8 and early 9.
Yes. Exactly. There was a phase when
late 2008.
When Indian market did well despite US market not doing well. But that does not happen immediately. For now, you have to go with the flow that if the US market is down, you also would have some bit of damage. But again, you know, as I said, you approach this market two ways. Either you identify your stocks and you buy them on all corrections, or you just decide that, look, let me stay out, let things settle where they do, and after that take a call. And don't get excited by, you know, one-day moves. Like yesterday, there was no reason for you to get excited that, okay, the market correction is over. Similarly, today there would be no reason to believe that, okay, you know, everything is going down.
All hell is gone.
It will keep changing because, you know, we don't understand why US market are making these 1,000-point moves on a daily basis.
No, why it becomes self-fulfilling is, yesterday I spoke with a bunch of fund managers and, you know, we will play a part of that chat to you. A couple of them said that there were people asking them, now can I stop my SIP? You know, this is how the retail flow can react. So it becomes self-fulfilling because people optically look at the fall and then take calls. So a flow that should have come exactly when the market's falling will perhaps disappear exactly at that time.
Exactly. And you know, just one final point. On the days when markets have given you gap downs, like on Tuesday, when the low was 10,276, the open was 10,295, the low was 10,276. You ended at 10,498, 200 points off the low point. Next day you opened at 10,600, went to 10,446. So what's happening in this market is that if you're having a big gap down, intraday you're not making money by selling. So today there's a good chance that intraday you don't make money by selling. Today you make intraday money by buying. And yesterday, for example, you know, from the high point, the market actually slipped. So
no, but there's no guarantee that that may repeat.
There are no guarantees in the market, of course, right? But all I'm saying is that you know, this market is not rewarding you if you're seeing early morning gap down and then deciding to sell. You know, that is not working.
Helping.
This is a tough market right now.
Okay, I know we are fixated with the way the US markets are panning out, but don't lose sight of the fact that oil has fallen for the 6th straight day in a row. So now Brent is below $65 a barrel, which of course matters to us in a positive fashion. So that's at least the light at the end of the tunnel. But let's tell you what our wise experts have to say as we head into trade this Friday morning. Jonathan Garner of Morgan Stanley thinks emerging market equities just made an important near-term peak. He says since the end of last week, emerging markets have also underperformed developed markets by 3%, reversing almost all of the year-to-date outperformance in January. He currently still has an equal weight stance on emerging market equities in a global context.
And now on to a quote from a big bond expert, Michael Hassenstab, who is the head of Franklin Templeton's $38 billion global bond fund, says, and I quote, "As the Fed unwinds its balance sheet, we should ask not whether yields will rise, but how much faster and higher than market expectations." He says only an extremely unlikely combination of events could ensure a smooth and painless transition. End of quote. Michael Hassenstab is best known for his huge one-way investments in EM-bet and currencies. He once bought half of Ukraine's sovereign dollar debt. So that's a big money bag and a big expert on bond situations.
Okay, let's get you some money market views and tell you how you should approach that space this morning. Bhaskar Panda of HDFC Bank says the dollar INR market has been a little more volatile than before, reflecting global sentiments. He's expecting a higher opening today and a range of 64.20 to 64.40 for the day.
And on bonds, the 10-year benchmark bond yield is likely to follow the US yields. It came down recently from the recent high of 7.6 in a healthy correction. Bhaskar expects it to trade in a range of 7.43, 7.48 for the day. Okay, so he's expecting bond prices to rise. Well, he probably gave this quote before he saw the US markets. We will have to wait and see.
Yes, let's see. But anyway, let's talk about those global cues. Here's Ronit with the world view.
So all three US indices deep in the red, with the Dow Jones now down 1,000 points. So Dow Jones has officially entered its correction zone. It's off 10% from its 52-week highs. And right now the Dow Jones as well as the S&P, they all are trading below their 100-day moving averages. So one of the reasons for this fall is the 10-year US Treasury yields. They are up around 2.8%. which is the 4-year high for them. And the reason for this is the weekly jobless claims. They have come in at a 45-year low. Now, moving on to an individual stock, Twitter, that's up 12% in the market as the company reported its first profit since listing. That's almost 4 years. Moving on to the European markets, they have also closed it in the red with the DAX. That was the key underperformer over there. And the Bank of England, they have kept rates unchanged, but the Bank of England have also said that they indicate to keep the rates going ahead, they'll increase it going forward. Moving on to Asian markets, they opened sharply lower. The Nikkei down more than 2%, as well as the SGX Nifty. That indicates a red day today.
Okay, thank you very much for that, Ronit. All those big numbers and those big red screens that you're pointing to. We'll get an expert to parse this for us. Jeff Lewis, Global Strategist Capital Markets Group at Manulife AMC, joins us on the phone line. Jeff, it's not stopping falling.
That's right. I think this is more likely to be a larger correction rather than just a 5%. That's not surprising given how much the markets had rallied over the previous to us, it's still more in the nature of a correction, a major inflection point, because after all, the outlook for the global economy, the outlook for corporate earnings, that really hasn't changed.
So you don't see this as the start of a bear market? This is rather a bull market correction, you think?
Yes, that's right. We've had these sharp corrections before. In fact, if you go back to the data from 1987, there have been something like 124 occasions on which markets have fallen by 5 or 10% or more. And the 70% of the time that's occurred in a non-recessionary environment, which we think is what we have now, then 90% of the time there's been a positive return over the succeeding 12 months. So to us, this is not the time to panic. This is a correction. It's a bit sharper. We know there's reasons related to that, such as inverse volatility products, low vol strategies. That's contributing, I think, to the of algorithmic selling and the way markets have been moving. But at the same time, we're pretty confident that the underlying fundamentals have not really changed.
Oh yes, that Credit Suisse, that product XIV, that really led to quite a bit of panic. But Jeff, good morning. What about emerging markets? Do you think we perform in line with the US, or do you think there could be some bit of decoupling from here on?
Well, I think so far the indications that EM equities have been a bit more resilient perhaps than in the past. In the past, the story goes that as soon as there's a sign of trouble, foreign investors pull money out of the emerging markets almost indiscriminately, regardless of what's happening to relative fundamentals. Now, I think the relative resilience we've seen this time is quite impressive, especially amidst the strengthening US dollar. Although there have been some markets, for example, like China, Korea, and Taiwan, which have been less resilient than their other counterparts.
Okay, finally, Jeff, are you buying this dip? If yes, which markets?
That is something I'd have to ask our traders on the team, and I think we were reducing risk positions really from the second half of January because we'd noticed a slight upward trend.
Okay, Jeff, there's some issue with your phone. So what we're going to do is we're going to wrap up the conversation. But we got a gist of what you're trying to say, that don't panic in this market. This is only a bull market correction, and you've seen many such corrections happen in the past. But Lata, you had a conversation with another big market voice?
Actually, there were 4 of them, but let me just play out one part of that conversation. I had actually 5 fund managers I spoke with. One of them was a portfolio fund manager. There were 2 mutual fund managers, and one of them was a private equity investor. We'll just play out one chat which I had with Sam Polyak, who is the portfolio manager at Fidelity Management and Research. He says this correction is a buying opportunity. He had no 2 doubts about the health of the US markets as well as the Indian markets. How would you describe the 4.5% correction in a single day, or the 8% correction from recent highs? Is this just a letting off affair, or is this the start of a deeper correction?
It's a great question. I strongly believe that markets can't go straight up without any volatility for forever. And so what we've had over the last week or so is just kind of getting back to normalized levels. Stocks are still up a lot over the past year. I still see the prospects for equity markets and emerging markets in particular as being quite good for a fair amount of time. This correction is healthy. There's nothing that I see globally or in the US that would make me think that fundamentals have changed that much in 1 week. So I wouldn't really worry about it. And if the correction continues, I'd see it as a pretty good buying opportunity.
Well, gentlemen, if you have any worries about the equity markets in the US, you're free to ask Sam or each other. But I just want to persist a little more, Sam. The questions about a little bit of correction is countered by people who say that valuations have never been so rich, that to get to even normal valuations, even a 25% fall will be par for the course, and only then we will come anywhere close to historical valuations. Is that right?
Well, it depends on how you look at valuations. A lot of people talk about the CAPE ratio, which normalizes margins. I believe the margins are higher and higher structurally. And so because of that, you have to look at multiples that are in the high teens, which are expensive. But at the same time, they're going to be getting a nice benefit. One, because the multinationals in the U.S. have a global book of business. And that book of business is much improved because of a recovery in places like India, and places like Brazil, places like Europe. So that's improving. You're getting that extra benefit from taxes that are coming down. So you're actually going to have earnings growth, accelerating earnings growth this year, which I think is part of the reason why the equity markets had done so well going into this correction. I don't believe those are going away. And so as part of that, I think overall the U.S. markets are very healthy. Global markets are healthy.
No, are you saying that historical valuation, 12-month trailing valuations may be unrealistic, but forward valuations in the U.S. are normal?
Correct. Because earnings growth is going to, in my opinion, is going to surprise to the upside.
Okay, that's a very, very optimistic view coming in on India. But let's do one thing. Let's talk about some numbers, some figures. When we come back from the break, all the stocks that you need to watch out for. CNBC TV18's top 10 list of stocks to watch. Well, as you can see, it's a brutal sell-off across most Asian markets. 1,200 points now gone and ticking lower on the Hang Seng, and the other markets too are following suit. But our research team is here to tell us what are the stocks that could be in the news this morning, irrespective of which way the market goes. So let's welcome all of them. Anuj, what would you be looking at?
So my first stock to track is Balrampur Chini, Sonia. Yesterday, it came out with poor numbers, but it was masked by buyback news, and that's why the stock went up 5.5%. It runs the risk of a classical 20 DMA halt, so my sense is it could be sold into. The other stock that I'm watching out for is, and you know, again, it's dependent on whether the market absorbs the first hour selling and starts to move up. That is crucial. Cement stocks rallied yesterday after ACC strong numbers. Today's India Cement's numbers. There was strong delivery buying yesterday, but once again, key would be to respecting the opening hour low, because in the morning everything would be down. So obviously, that there will be some stocks which will respect the first hour low, and some which will break that first hour low. That distinction has to be made clearly.
Okay, well, we have a bunch of results. See, we are not trying to tell you that all these numbers will be green or red as the results indicate, but these are numbers that we have to keep on our radar. Mangalam, your first set?
My first set, Lata, I will have Glenmark in that. Yesterday's Cipla operational performance was good. Glenmark absolutely bad. 58% decline on the EBITDA after the revenues were down 13%. Revenues from the US were down 40%, so that is something that the street will be mindful of. Another one that I'm watching out for is Manappuram. Their assets, AUM growth was muted at 0.7%. Gold portfolio asset quality improved quarter on quarter, but the microfinance portfolio asset quality deteriorated. But the bigger trigger for them, of course, is the rumors on the street of merger or acquisition. We'll keep an eye out on that. SAIL, Steel Authority of India. Through the quarter, the Steel Secretary has been saying that the numbers would be good. They are doing some rationalization in employee cost, and the company posted a good set of numbers, turned profitable after 10 quarters, operating profit at 1440 crores, and employee costs have declined quarter on quarter. Petronet LNG, the revenues were absolutely flat, closer to that 7,760 crore mark. The operational performance was a bit of a miss. Margins deteriorated slightly, which caused a dent of 10% in their net profits.
Okay, so those were some of the big numbers, but we have a lot of smaller numbers that came through as well, important ones there. Sonal has been tracking that for us. Sonal, what do you have?
Well, I have a couple of results on my radar today. I'll start with SKF India. Good set of numbers. The revenue was up 5%, but the EBITDA came in higher by 36%. All this leading to profit expansion of 32%. The other one I'm tracking is Trent Limited. Though the revenue was up 20%, even the EBITDA came in higher by 45%, but the profits were flat, largely due to higher tax expenses. Excel Crop Care, strong set of numbers. The revenue was up 45%. EBITDA growth was 193%. Even the profits came in higher by 392%. So good performance operationally. Brigade Enterprises, the revenue was down 24%, but because of lower costs, they've been able to expand their margins by 1,450 basis points, and all this leading to a profit increase of around 45%. Gujarat State Petronet, revenue growth was quite steady at 5% increase, but the profits were up 3% majorly because they were lower costs, and also there was margin expansion of around 30 basis points. ABB India, the revenue went higher by 10%. Operating profit margins also went up higher by 30 basis points, but the order inflow was quite positive, up 19% on a yearly basis. Back to you.
Okay, thanks a lot for that, Sonal. By the way, I just want to point out that HDFC Bank ADR, for example, yesterday was down 3.5%. ICICI ADR was down 3%. So there could be quite a bit of weakness in some of these large banking names. So just keep an eye on some of these as well. And right now, if you look at the Asian markets, the Shanghai and Hang Seng market are both down 4% right now. These are big markets, of course, the two biggest Asian emerging markets, and down about 4%. But Ronit, what about other results?
Yeah, a lot of results on my radar. I'll first start with Parag Milk. Strong set of numbers coming in for the revenue was up 16%. They reported an EBITDA profit versus a loss, as well as their PAT was at around 25 crore versus the last quarter. Moving on to Coffee Day, another strong set coming in for them. The stock had a 20% upper circuit in the last quarter, and a good set again. Revenue up 26%, EBITDA up 11%, as well as the CCD same-store sales growth that came in around 7%. This is a 24th straight quarter of same-store sales growth. Moving on to Butterfly Gandhamati, a lot of influential investors in this, and a strong set. Revenue up 58%. Reported an EBITDA profit, as well as the PAT was up by 1.6 crores. Moving on to Balmer Rory, good set coming in. Operational efficiencies kicking in. Revenue was up by only 8%, but the EBITDA, that was up by almost 59%. The margins, they expand by 500 basis points. And finally, one weak result is Torrent Pharma. Revenues were flat around 2.4%, but they reported a profit down to around 75%, largely due to higher finance cost as well as lower taxes. Moving on to Fortis. Positive news coming in there. The Singh brothers, they have tendered their resignation from the board of Fortis. Basically, this is to distance themselves from the company in order to insulate the company from their ongoing legal processes. Back to you.
All right. Thank you very much, Ronit, for all those numbers. Again, I want to reiterate, we are not putting it as the top 10 gainers and losers simply because we only know that the results are good or bad, but the reaction of the market could be determined by other factors. The market's in the grip of its own forces. So how do you delineate those forces? What can be the dip? Again, let's go back to that Edelweiss India conference last evening. I caught up with some of the top fund managers, and the unanimous opinion actually was that you must buy the dip despite the rise in volatility. One point which Navneet Munot made very clearly, and I think that point needs to be taken home. Last year was the lowest volatility we have ever seen. This year, no matter what happens, the volatility has to be higher than that. You can't find a volatility lower than 2017. So this is par for the course, was one of the takeaways, but listen in. What kind of a downside possible in this market? It just soothes nerves, and that's why this question. I mean,
I'll pass that. I really can't take a shot at short-term downside.
Vishal?
I don't think there's much downside, to be honest, because I actually come from the view that I think people and investors, like Sam pointed out, one of the reasons flows haven't come in is because people are worried about where valuations are. So unless you have some black swan event, which, right, no one can predict, okay? But in a normal world, if there is some crack in the market, even a bit, there are buyers waiting because the story's good. The fundamentals are good. That's my view.
No, I mean, I would think so. At the first dip, people would put more money. As Sam has been saying, it's a hated bull market, at least in the United States. What would your guess be, Vishal? Do you think, I mean, Vikas, do you think we can get away with a minor fall only this year? Because of all the factors that will have underlined.
So again, difficult to predict, again, unless there is a major, some macro, which is, black swan event, as Vishal was saying. I mean, we will be around 580 to 600 kind of nifty, EPS. And I would assume that at, 16 to 18 kind of PE range, which is like roughly about 10,000 of nifty, there will be enough and more buyer given the kind of growth ahead of us. So I think probably somewhere there will be a lot of money in case suppose the market falls. I doubt I'll be, that market would really fall below that, but markets are always difficult to predict.
No, I'm only asking you for what can be a reasonable fall. We have to exclude black swan events, of course. So a max of another 5, and you would think 4-figure Nifty is unlikely, Vikas? A 4-figure Nifty is not something that would be your base case.
Possible, it can happen, but I would assume that that is where lots of money will come in and start getting invested, and on a given day, on a given particular week, market can go to any level. It's difficult to predict.
Fair point. Fair point.
So Lata is likely to get a big bonus check next month, and she's asking, should I invest? You're going to get a large bonus check, it seems. I want to make sure whether to invest now or wait for when the Nifty is in 4 digits. You've been trying hard to get that confirmation. Am I going to see Nifty in 4 digits, isn't it? But on a more serious note, I completely agree with you that I think investors have forgotten volatility. And this is a beast that we have to live with this year. This is my strong view. I think markets have been extraordinarily calm globally, and any kind of risk at any point in time on the horizon, whether it's towards the missile firing in North Korea or early morning daily tweets by Trump or whatever, that did not make any difference any time. I mean, in terms of the stability in the market, I think we are going to see higher volatility. That's a strong view I have. But from the investor's perspective, if the soothing the nerves, I think for the next couple of years, the micro looks interesting. I think India had an extraordinary macro. That at the margin, probably you may not see incremental improvement there. Probably you see a little bit of deterioration. But from a micro story, I think purely bottom-up looks very interesting next couple of years. But those returns are not going to be like coming in that linear fashion where every year you will have what we saw in mid and small cap last year. There are several pockets where there is a bit of froth, and that needs to get corrected. We have seen a lot of that correction happening in the last couple of weeks, and I think that trend we'll see for some more time. So brace for volatility, but remain prepared to put money on dips.
Okay.